The IUL is too expensive. Just stick with your 401k. Plus, you get tax deduction. Have you heard that one before? Today, we're going to dive in to see which account is more favorable when comparing taxes and fees. My name is Amanda Ryba. I have been working as a licensed financial coach and consultant for the past 8 years, as of the date this video is produced. And it is my goal to illuminate to the world what wealthy people do with their money. And one thing all wealthy people understand is you have to give in order to gain. Let's dive in. First thing we need to do is calculate how much you are saving by contributing into your 401k. So let's just say, for example, you are a healthy 35-year-old male making $150,000 a year gross earned income and you're single, not married. Let's say you are max funding your 401k, you're contributing $23,000 a year. Making $150,000 a year as a single individual puts you in the 24% marginal tax bracket. Now, marginal does not equal effective, right? So your effective tax bracket prior to contributing into your 401k would have been about 17.3%. With the contribution into the 401k, that doesn't lower his marginal tax bracket, that lowers his effective tax rate down from 17.03 to 15.76, which is about 1.2% in savings, which means he's saved a total of $5,520 in taxes every year by contributing $23,000 a year into his 401k. Now what we have to do is calculate out how much it costs to own the 401k. According to Google, the average fees of a 401k can range anywhere from 0 to 2%. So we're going to be conservative and assume that it's just a 1% fee to own your 401k. If you Google MoneyChimp 401k calculator, it will take you here where you can actually estimate out the cost and the value of what you expect your 401k to be at retirement. So let's just assume he's starting with nothing in his 401k, zero balance, and he's contributing $23,000 a year. Let's assume that he's getting a 3% match, so dollar for dollar up to 3%. 3% of $150,000 is $4,500. And let's assume that there is 30 years until he plans to retire. He's 35 now, he plans to retire at age 65. According to Google, the average rate of return for a 401k is somewhere between 5 to 8%. So let's assume that he's earning an average 7% rate of return every year over the next 30 years. If we click calculate, that means the balance at retirement of his account is estimated to be at $2.779 million. Now, in order to calculate what that 1% fee would cost, all we simply do is change this investment rate of return from 7 to 6% because we have to calculate out the fee. Now, that estimates that his balance at retirement would be $2.3 million. So if you do the math, that means paying that 1% fee every year over 30 years is costing him $474,000 over the accumulation years of having his 401k. Now let's calculate out how much he can expect to receive in income in retirement. Number one golden rule of investing is the closer you are to needing your money, the less risk you should be taking on it. So while he may be in very risky investments when he's young and he's accumulating wealth, he's most likely going to shift his portfolio into bonds, which are more conservative. So instead of earning what was 7, which really was 6 right after the fee, he might only be earning maybe 4% or so per year in retirement. So let's subtract and say that's 3% minus his fee. Let's assume that he lives from age 66 to age 90, which is 25 years. And average income tax rate for people today is about 20 to 25%. His current marginal tax rate is 24%. Now, the question goes to you on whether or not you think taxes will go up or down in the future. I beg to just say, let's just keep it the same. I actually always like to err on the side of caution when it comes to taxes and always estimate a little bit higher, just because you don't know, right? With the way the economy is going today, we're only, $34 trillion in debt and counting. Highly doubt taxes will realistically go down. So if we want to just be conservative, and let's just put him in at 20%, right, for taxes. If we calculate this, the estimate is that he would expect to receive 128, we'll just round it up and say 129,000 every single year in income in retirement, minus 25, almost $26,000 every single year in taxes, means he would walk with about 102, we'll round up and say $103,000 per year in income in retirement. Not bad, right? However, if you do the math on what he'll be paying in taxes in retirement, it's estimated that $25,000 over 25 years this individual could expect to be paying about $642,000 in taxes in his golden years when he needs his money the most. Now, let's compare this to if he were to do the exact same thing, but instead of putting that money into his 401k, he redirects that into an IUL. Here's an example. Again, he's a healthy 35-year-old male that doesn't smoke, and his goal is to save not $23,000 a year into here because we have to subtract taxes, right? So if he wants to contribute into an IUL, he's got to take that $23,000 in as earned income, which means he's no longer going to get that $5,000 tax deduction every single year. And that means he's going to have about 19, give or take, after taxes that he could probably contribute into his IUL every single year. So if we look over here, policy year is how many years the account has been opened. Age is how old he is in counting. Premium outlay is just showing what he's saving into the account every single year. So let's just assume he saves $19,000, which is after tax dollars, into this account every single year. If we look over here on the right-hand side, accumulated value, that's his cash. That's the money that's growing behind his IUL. Surrender charge, this is how much of his accumulated value the insurance company is not giving him access to. And then surrender value is how much he has access to touch. So for example, he's got $17,000 in here. They're not letting him have access to $9,000 of it. He can touch $8,244 in year one. And then the death benefit is set to be an increasing death benefit, which means if he were to pass away, his family would get the $500,000 death benefit that is required for this policy to work, in addition to the $17,000 that's in the accumulated value category. His family would get all of that tax-free. From day one of signing the account and making your first deposit, if anything happened to him, his family would collect both inside the account. What you'll look at here is there's 4 main charges with the IUL. We've got the premium expense charge, cost of insurance, policy fee, and expense charge. So by age 64, which is 30 years from now, it's estimated that he could have contributed about $570,000 after taxes, and the account value could be at $1.545 million. And keep in mind, this is only showing a 6.42% rate of return when these accounts have consistently averaged 9-10+% over a 30-year span. But now let's take a look at the fees. Total fees during his contribution years, the 30 years that he's putting money into the account, total 109, we'll round up and say $110,000 compared to $474,000 inside your 401k. Now let's see what he can expect to receive in income in retirement. The good thing is here, we don't have to worry about adjusting the rate of return in retirement because these accounts grow indexed to the market, which means you can't lose any money. You can still earn really great rates of return with zero risk. So we're looking at him earning an average about 6.42% rate of return. And in retirement, because we don't have to change the interest rate and we don't have to subtract out taxes, it's estimated that he could start withdrawing $130,000 every single year in income tax-free from his IUL. So if you do the math, that's a difference of about $27,000 every single year in income in retirement by going with the IUL over the 401k. So to summarize, if this person paid just 1% in 401k fees during the accumulation period of his account, he would have paid $474,000 in fees compared to his IUL, where he would have paid about $110,000. That's a difference of just about $365,000 in fees. Then when we look at income, an estimate of about $130,000 every year tax-free from the IUL compared to about $129,000 every year from the 401k, but then you have to subtract out $26,000 a year in taxes. So his IUL is getting him potentially an additional $27,000 a year in income tax-free over the 401k. Now keep in mind, the cost of an IUL varies drastically because it really depends on the individual's age, health history, background, and sex. Yeah, I hate to break it to you, men are actually more expensive than women. That's why I chose a man for this example. Therefore, the older you get, the more money you would have to save into your IUL to get the same result, same as with your 401k. Again, this is just an example. These numbers could vary drastically at different ages and different health ratings. The key is you want to sit down with a licensed financial professional where you live to walk you through these numbers. Somebody that can walk you through the estimated value of your 401k when you retire, and then compare that to an IUL if it's something you're interested in owning. But as you can see, the numbers are the numbers and math doesn't lie. So if you live in the United States and you want to explore this option for yourself and you'd like to work with me or my team, click the link in my bio. It'll take you directly to my calendar where you can book a call with us. If you like this video and you want to see more content just like it, click that subscribe button and of course, turn the bell on to get notifications because I release a new video every single week and I wouldn't want you to miss it. I love it when you stay till the end. Please share this with anybody else that you know that has that same comment that IULs are too expensive and you get the tax benefits of the 401k. Share this with them to educate them and let them know that that might not always be the case. Again, my name is Amanda Ryba, founder of the Illuminate Your Wealth community, where it's my goal to educate people on what wealthy people do with their money. Signing off for now. See you next Tuesday.